Well, hello, everyone, and welcome to the Benjamin Z. Miller Investor Networking Group. Today, we have an interesting presentation on value investing. This is the type of investing that has been made famous by Warren Buffett and his professor at Columbia University. We're going to go through all of that, but essentially the idea of it is you are purchasing an asset for below the intrinsic value, and the intrinsic value is defined by aggregating, by summing the discounted cash flow of the stock. So we'll just take an example here. So Benjamin Graham was Warren Buffett's instructor at Columbia University. And Professor Graham, he wrote a book called The Intelligent Investor. And this is like the Bible for value investors, where they read this book and they study it. Warren Buffett became the most famous of Benjamin Graham's students, but other students were also very successful using this methodology. And if you've heard of Sequoia Fund, that is one fund that was some of the ideas that they were using were based on value investing. There's a lot of other examples. I've got some supplemental information on that. But basically, Warren Buffett, he has over the years accumulated a massive degree of success using value investing. And what he's always trying to do is to price a stock based on future, the current value of the stock today, and then you're trying to make a projection into the future about what may actually happen. So Warren Buffett, you've got kind of this illustration here that shows how it works, where there's a lot to it in terms of putting it all together, but once you've got a good handle on all of it, you can use this as a method to make money, but it's something that's done over the long term, not over the short term. So to do a discounted cash flow valuation, if you just imagine that you come up with some value by summing the cash flows in future years, and let's imagine that you go through this calculation and you get 100 million as the value of the cash flow. Let's say it's some, for example, privately held company. And then to determine the value per share, you're going to divide by the common shares outstanding. So in that example, it would yield a price of 100 million divided by 10 million would yield a value of $10 per share. This method is the same whether it's a publicly traded or a privately held company. So value investing, you're just performing that calculation. But to get to the calculation, you have to do a few other steps with it to get it all correct. So why the shares outstanding? Well, when you form a corporation, there's several types of shares, and I've got an illustration here that shows that. Basically, you've got the authorized shares. These are in the corporate charter. When the company's first formed, how many shares are there? And then you can have a category of unissued shares, and then you have another category, issued shares. And then within issued shares, you've got two categories of stock, treasury shares and outstanding shares. So when you do the calculation, you're going to divide by outstanding shares. So that's how you get the value per share. So what is the par value of a stock? When you form a corporation the first time, you will be asked to put in a par value for the stock. And one of the important things is you want to pick a very low par value when you're forming a corporation, because if you pick a very high par value, a lot of new investors, they may think that's a good idea to pick a high par value because they think it makes the company sound more valuable. But all that it does is it generates a very large potential tax bill by putting that in. So you always want to pick a low par value. And the value that I always like to use when I register companies is 0.00001 dollars or euro or pence per share with 10 million common shares. That has a nice effect because it sets it at $100, 100 euros, 100 pounds, whatever it might be, is the initial starting value. So if you form a company that has, say, 10 million shares, and you've got a total of 10 million shares, and you set that low par value, you're not only reducing any potential tax bill that you might get, but you're also in a position where it works out beautifully. So if the startup issues, say, 7 million shares, and the founders are going to write checks to pay for those shares, they would only front $70 or 70 euros. So it's just a nice thing. So I always like 10 million shares and then 0.00001 for the par value. So how do you value a privately held company? It's exactly the same as how you value a publicly held company. However, if you're talking about a publicly held company, if you're looking at other methods of valuing where you're not doing value investing, if you move from value investing into other methods of investing, for example, that can change the value, because a common method that is used with companies is what price earnings ratio. And once you move from a privately held company to a publicly held company, the value typically is going to double, maybe even triple for the same level of earnings. So that's something that's important. But from the perspective of value investing, that doesn't have any effect on the discounted cash flow valuation, except it could indirectly be factored in because it has potentially a lower cost of capital. A famous quote from Benjamin Graham is that in the short run, the market is a voting machine, but in the long run, it's a weighing machine. And the idea behind this is every day the people are having a reaction, where now Tesla is a company that everybody's excited about, so it has a very high valuation. But in the future, if Tesla were to have problems, the valuation could swing in the other way, where it greatly goes down. But there's some value there based on the earnings, based on the potential. So what you do is when you're doing value investing, is you define a discount rate. There's many different discount rates that you could use, and they're all going to yield different values. But the easiest discount rate is if you pick what your minimum return on capital would be. And let's imagine that you say your minimum return on capital is 10%. In that case, you would set the discount rate at 0.10, it would go in the denominator. Whereas if you want to get a 20% rate of return, that's your minimum, then your discount rate increases to 0.20. So this is something that has to be taken into account, and it can vary from investor to investor. There's a lot more information that is included in this slide deck in the supplemental information, and I'm going to get everyone that's at this meeting a copy of that. And just a couple of reminders. Please, if you're at this meeting, please check the sign-in sheet. I think everybody here is already on the sign-in sheet, so nobody needs to fill anything in unless something has changed. And then I encourage you, you are welcome to invite your friends or colleagues. If you find these meetings beneficial, you're welcome to invite them. You can share the link. Or you can just invite them. It's something where the more investors that we can get at these meetings, the better it is for us. And then if you're watching this on the internet and you're thinking, that sounds interesting, I'd like to learn more about that, I'd like to learn how to invest, just reach out to me, folks. I am available for mentoring. I love to help people. So just reach out to me if you are interested in that. All right, so that is it for our presentation, and I'm going to stop the recording now, and I will take any questions.